Hi, Greg Dorsey here at Leeb.com, Leeb.com. It's Monday, August 1st. Well, all things considered, the damage in the stock market today from the debt ceiling agreement and weak economic data wasn't so bad. Stocks were in the red, paced by healthcare shares collectively down about 2%. But the S&P 500 lost just 0.4%, with the small caps and mid-cap shares giving up only slightly more. Ultimately, the debt ceiling agreement calls for $2.4 trillion in cuts over the next 10 years. But total discretionary spending in fiscal 2012, which begins October 1st, will be capped at $1.043 trillion. That's just $7 billion less than current levels and only about $31 billion below the assumptions the House Appropriations Committee has been working on prior to the agreement. Still, expectations for austerity at a time when the economy is already weak isn't a good thing. It may prompt consumers to reduce spending, in contrast to the bill's proponents' hopes that it'll actually spur private spending. And the message from the bond market, with the 10-year Treasury falling to 2.82%, lows not seen since last November, tell us that deflation and economic contraction expectations are increasing, contrary to the Federal Reserve's hope for fostering of at least a modest amount of inflation. We'll be watching interest rates, particularly the 10-year Treasury, for an indication that the Fed is gearing up for another round of money creation via quantitative easing. A decline of, to say, 2.65% or so would almost certainly mean more money printing was on the way. The Federal Reserve Bank of Kansas City's Economic Symposium out in Jackson Hole, Wyoming, at the end of the month could be the venue for such an announcement, as was the case for QE2 a year ago. As we've pointed out in the past, expectations that the Fed will fire up the printing presses again, if need be, should keep a floor under share prices. But unless we see economic growth start to pick up, stocks aren't likely to take off either. So more of the same, lodged in a trading range that could drag on for some time to come. That's all for now. Thanks for stopping by, and we'll see you again later in the week.